Good morning and good afternoon, wherever you are in the world. This is Jon Medved. I'm the CEO of OurCrowd, and we're going to be with you for the next hour talking about how to navigate startup investments through this corona crisis. We appreciate you taking the time to be with us. We prepared a variety of comments for you. We start always with a legal disclaimer and just want to review the agenda. After my opening remarks, we're going to hear a medical update from the head of our medical investments, Dr. Morris Laster. We're then going to talk about the implications of the debt and equity markets for the venture market from Alec Ellison, our US chairman. Our guidelines and best practices for companies will be covered by Ron Stern, who heads our portfolio. And we'll then talk about our portfolio companies fighting the virus and some reflections for investors. We'll then discuss how we can provide business development assistance with Lolly David, who runs our biz dev group. And finally, we'll wrap up with how we can mobilize our community together, myself and Alec, and then leave adequate time for your questions and answers. I want to say that we're already getting questions online. Please feel free to put your questions in, and if we can address them in the midst of these comments, we will. Otherwise, handle them at the back end. So right now, the current situation here in Israel is that we have, as of last count, I think 433 infections. Less than 20 of them are serious or moderate. I think we're at 5 serious people. Believe it or not, we've had no deaths, thank God, here in the country. The country is near total lockdown. People are being encouraged to stay in their homes. There's almost a complete travel embargo, and there are significant corporate and government restrictions. The government has sent home 80% of their employees, and each company is limited to up to 30% in their office. We're here today broadcasting from the OurCrowd headquarters in Jerusalem, but we're with skeleton staff. We are working full time. Our entire team is still hard at work, perhaps harder than ever before. Most of us are working from home, and we're working to support our companies and to identify selective opportunities and get in front of this. Let me tell you, unfortunately, that it's going to get a lot worse before it gets better. It's not necessarily true for every country in the world. It seems as though Asia is pulling out of this in a stronger way than the West. We heard today that there are no new infections, at least as reported by the Chinese government in Wuhan, and that's obviously a sign of positive developments. But in general, the world is headed into a tailspin, and it's going to take time for this to get better. But it will get better. And what we are advising our investors and our companies is you got to be in the tube. That's an old surfing analogy. I grew up in Southern California. That's why we had that slide. This is about finding the wave, that perfect spot in these big waves where you can survive and actually come out intact at the back end. I want to remind you that great companies are built in downturns. Some of the world's best companies were stress tested in prior down markets. We believe that technology has a big role to play in not only solving, but helping us get through the crisis. Cash is always king, and we're advising our companies to get their burn rates right and to save their cash. And we're also advising our investors that you need to have cash reserves available so that you can support and follow on your original investments with your companies. All of our companies are being advised to stay close to their investors, in fact, closer than ever before. And we're taking advantage of government benefits both here in Israel and Europe and the US. Asia will indeed come out of this crisis first, in my opinion. It's already pretty obvious. And they're going to be out of this looking for investments. So we're actually bullish about working with you, our Asian investors, on how we can not only get our companies into the markets, but how we can work on the next wave of investment together. But we need your help because we really have to mobilize our worldwide community. And so far, so good. Last night, we had a very positive Western-oriented webinar. Today is for Asia. We'll be continuing to be reaching out to you and making sure that we're staying in very, very close contact. I want to share with you a new index which Bloomberg has started publishing. It's called the Bloomberg US Startups Barometer. And what it is sort of a, call it a blended uh, picture of how startups are doing in the market. And from a year earlier, not so good. Okay, it's down almost 45%. Now, that barometer consists of four different specific activity barometers, and that is deals, where the number of deals that have been done for startups is down almost 48% year to year. The deal amounts down, not quite as steeply, but about 27%. First financing's down even more, 51%, and exits also down 51%. So clearly, the startup market certainly is seen by the US barometer, and I think that's reflective of much of the world, is quite down. Now, just remember what I said earlier, that great companies are built often in bad markets as well as good markets, but the ones that are built in bad markets get a real stress testing. So at this point, I'd like to turn it over to our medical partner, Dr. Morris Laster, for a briefing on the medical situation. Morris?
Thank you, John. So I think we'd like to start with know your enemy, the virus, COVID-19, or as it's known, severe acute respiratory syndrome, coronavirus 2. It is a single-strand RNA virus and similar in this respect to the HIV virus. The incubation time is over 2 to 14 days. Primary spread is via respiratory droplets, person to person, or via secondary spread by touching an infected surface. The diagnosis occurs via RT-PCR, polymerase chain reaction, and CT scans. And the mortality rate is currently around 3 to 4%, depending on age, where it goes up dramatically. Next slide, please. So the symptoms, as we all have heard, fever, dry cough, fatigue, shortness of breath. Recently, another symptom has come to fore, the loss of smell. But we all have seen these, and we can move on to the next slide, please. I think this is the most important slide I want to present to everyone. Why is this such a problem? So point number one is that we're neophytes to this particular disease. It's been living in bats and somehow has made the jump from bats to humans. We still don't know what the intermediate host was, but it has done this. And there is no herd immunity because we haven't seen it. The long incubation period where you can shed virus and be infectious without even knowing or being symptomatic over a 14-day period. What's called the R0, or the basic reproduction rate, is very high, where that means that a single person who is infected with the regular flu will only infect a little over one additional person. The rate with COVID-19 is up at about 4 and maybe even more. The concept of super spreaders, where you have people who are asymptomatic or mildly symptomatic, just going around and spreading the disease without knowing. Another issue is that many of these people who are infected will feel fine for a week, and then all these symptoms happen at a boom. 14% will require hospitalization, 5% will require intensive care unit care, 1 to 2% will require a ventilator. These are the things that overwhelm a healthcare system. And obviously, there's no specific vaccine or specific drug therapy. When we look at the timeline, I think start to get optimistic, actually. Whereas the first clusters were seen in December 30th, the virus is isolated 7 days later. 12 days later, the whole genome was sequenced. And then you start to see the outbreak of disease. This is very telling in the fact that the science and our technology has been brought to bear, and the quickness with which this happened is unprecedented. This is a slide from 2 days ago where we had 173 cases. This is now at 220,000 cases, and obviously increasing. When we look at previous pandemics, the mortality rate for coronavirus is much lower than SARS or MERS. What I want to focus on is the right-hand aspect of the slide. So what can we do? Social distancing. When we looked at the Spanish flu in Philadelphia, where there was no social distancing, you had this tremendous peak, and then the disease peters out. However, when social distancing was enacted in St. Louis, you see a flattening of the curve, which is what we want to do to save our healthcare system. Next slide. And this is a more detailed slide on the same thing. If we don't kind of push this thing out and flatten the curve, we can end up in a situation, unfortunately, like what Italy is facing in northern Italy. Next slide, please. Reasons for optimism: vaccines. Moderna has begun its phase 1 clinical trial 2 days ago. Unprecedented quickness. They sent their vaccine to the NIH. 2 weeks later, the trial was approved, and we're already starting to have patients in the trial. Here in Israel, Miguel Galli Research Institute has been working on a coronavirus vaccine for chickens and has been adapting it to humans. And in record time, the Israeli Ministry of Health has approved 8 drugs to treat the COVID-19 outbreak. So you're looking at technology and the governments working together to actually beat this. Next slide. Thank you very much.
Thank you, Morris, for your comments. We're now going to talk about the implications of the debt and equity markets for the venture market, together with Alec Ellison, our U.S. chairman. Alec?
Thank you, John. As John indicated, I'm going to touch on developments in the U.S. equity and debt markets in the context of their relevance for the venture market. If we look at the last 3 major market declines, they're all different from each other and from the current crisis. Indeed, what often generates a crisis is when there is not a close historic parallel and therefore ready playbook to call upon, as history rarely repeats itself. Yet each of these crises generated lessons and tools that are being applied to today's crisis to help with the necessary bridging of the system over a defined shutdown period. In the '87 crash, computerized trading nearly brought down the market despite a healthy economy at the time. And one remedy was the installation of circuit breakers, which have already been employed 3 times in the past 2 weeks in the U.S. In 2000, we did have a major misallocation of capital to dot-coms and even more so to telecom. And then, of course, 9/11 compounded the challenge by closing the markets for several days in the U.S. and then raising the specter of a hot war. The lessons learned then were, first of all, avoid nonsensical new valuation metrics, and post 9/11 to be sure to have off-site electronic trading systems. And you may or may not be aware that the New York Stock Exchange's floor is now being closed, but that should not create any problem with ongoing trading. Finally, in '08, we had yet another major misallocation of capital. This time it was to housing and a true financial crisis. The biggest lesson learned is not letting a major financial institution, i.e. Lehman, fail. Back in 31 to 32, we'd learned the lesson, don't even let a small bank fail, but Lehman mistakenly was not viewed as a bank. The analog today would be watching out for a major health insurance company in trouble if patient levels started to surge, or worse, a life insurance company under threat if deaths surge. So hopefully policymakers are looking for both and paying attention. The new tools from 2008 have included driving interest rates to zero and quantitative easing, which was applied in early 2009 and marked the bottom. So all 3 tools I've referenced, circuit breakers, non-physical floor trading, and zero rates and QE, are being used during this crisis. And the result is that we have a financial system that is functioning. The banking sector is well positioned to weather this with less reliance on debt, more cash on hand than in '08, the stress tests over the last decade, the emergency toolbox I mentioned, and very importantly, you don't have a political dynamic where banks, or frankly any industry, can be blamed as they were in '08. In '08, the blaming of the banks is why the so-called bailout initially wasn't even passed by our Congress, but then was a couple days later. Next slide. Next slide, please. So this is good news for major companies and industries, or at least less bad news, as governments can create public lifelines in such crises. But that's not necessarily that meaningful for small businesses, which have less cash to weather liquidity challenges. If a small business, one of our startups, has less than 12 months of cash, they can't look to the government. Well, we keep telling them, though, not to be embarrassed or defensive, because every airline in the world has less than 3 months of cash if they don't get assistance now in some form. And we will and are seeing a large increase in loan demand from small businesses. The issue is how many will get loans before they go under. And they're hit even more so by lower consumer spending and tightening supply chains in most large businesses, the exception being industries like the airlines that are pure service oriented and have massive fixed costs. In short, small companies are going to have to fend for themselves in a very different dynamic than for large companies. Next slide. And so the result is, even though we don't see it on our screen every moment, private company values have declined sharply. We just don't see it. It will be reflected in multiples. It will be reflected in the denominators of revenue or earnings or cash flow. And there's also going to be less M&A. They'll have a challenging exit environment. And this isn't necessarily because buyers will disappear. Buyers will be chomping at the bit, and frankly, we're already seeing it and hearing anecdotally of this in the context of having companies that have been in their sights for a while that now look more reasonable. But seller responsiveness and the shift in psychology takes time for these two to come into sync. And fundamentally, this increased uncertainty in the environment simply drives up the risk premium, the discount rate, if you will, for growth companies whose revenue and cash flow is further out in the future. But I'd say that's just for now, because ultimately, if we believe we are in a even lower secular interest rate environment, growth companies become even more important once the dust settles, and more valuable once the dust settles. It'll take a while. So where we're likely to see winners, losers, and I call reformulation. I alluded to historic misallocations of capital, and that those adjustments can cause crisis, whereas we really haven't had a misallocation of capital in this current environment. But we do see a shift, some secular shifts, which will create winners such as communications and virtual services, healthcare equipment and preparedness, so that the system that Maury alluded to has even more capacity in the future, and then hardware and software vendors to the above. Losers, commercial real estate. We're all probably learning that you might need a little less office space, that you can work more remotely, and this is going to hurt that market. The oil industry has been in decline for years. Was in crisis in 2016, if you remember. Came out of that. Is in a worse crisis right now, and we may be seeing as an acceleration of the long-term decline. The allocation of capital from oil to other industries will create opportunity. And finally, what I'll call a reformulation, not necessarily a loss, but reformulation in travel. And then I've alluded already to life and health insurance. I suspect we'll see reformulation in those areas because the next pandemic, God forbid, could have much greater threat to life and even more challenge to the healthcare system. Next slide. So in summary, the good news is that currently financial markets are functioning. Market valuations are lower in the private markets. We just don't know how much lower, but substantially, and that the pandemic shock will drive reallocation of resources to and from select industries. And you'll hear more over the next hour in just how some of the above will guide our investing going forward.
Thank
John?
you very much, Alec. And we're now joined by Ron Stern, who heads our portfolio management group, to talk to you about the kind of guidance that we're giving our portfolio in this time of crisis. Ron?
Hi, hello everyone. Thank you, John. So even before we go into the crisis, just a little bit of background on what we've done to prepare for this crisis. So obviously nobody knew about COVID-19, but from the beginning of 2019, we've been very focused in helping our companies and pushing our companies to raise as much capital as they can, with a view that if there is a softening in the markets, you should be as well capitalized as possible. And in fact, we just pulled these numbers yesterday, and we've been successful in doing this with 32 of our companies, raising a total of $480 million from the beginning of 2019 alone. This puts us in a relatively strong position coming into the crisis, where most of our companies have a runway of more than 12 months. So our average runway in our portfolio across our entire portfolio is well over 12 months, and this does not put into consideration any adjustments to burn that we will talk about soon, that the companies are now making to extend this runway. It's minimum 12 months on average before adjustments are made to extend that even further. So that's a relatively good position as a result of tremendous work done here to help our companies be very well prepared. The second thing is, okay, now we are in the crisis, and what are we doing to get out of it and to make sure that our companies are strong and thriving when they come out of the crisis? So the first thing we're doing, obviously, is we're talking to every single company in our portfolio and getting a sense to where they are, emphasizing the messages that we'll talk in a minute, and trying to help them in any way that we can. And the second thing, just to say before we go into these specific things that we're telling the companies, is that the world is not ended. What we're seeing, even though this might come to a surprise to some people on this call, is that we're seeing activity, although a lot more cautiously, still going on. So 2 of our companies are closing rounds, very significant rounds. Together, it's going to be about $80 million that is going to close this week or next week, and seems to be going very, very steady. And 2 of our companies actually received initial term sheets from the beginning of this week. So this gives us, and discussions that we have with other VCs, some VCs are taking a little bit more cautious, but a lot of them are still in business, continuing with term sheets that they have on the table. And it seems that at least the VC community is not completely freaking out, as a result of what's going on in the markets as of today. So the messaging we're giving to companies, one is don't fight the wave, ride the wave. Our companies are very agile. A lot of them can adjust quite quickly to new realities. And we're urging them to find what in this new world, the distant learning, the social distancing, obviously the medical applications, what in this world can you do with your technology, your team, and your offering to make it more relevant for the world as we see it today? The second thing is talk and be very close to your customers. Don't just assume that because your customer has been there for the last 2 years, they'll be there for the next few quarters. Have an active conversation with them, understand what they're doing in the midst of this crisis, and find and figure out what you can do to be supportive to them in the future. The third point is reevaluate CAC and LTV. CAC is the cost that it takes you to acquire a new customer, and LTV is lifetime value of that customer. We believe that in many industries, this traditional matrix is going to need to be reassessed. Sales cycles might be extended, churn might grow, the lifetime value of your customers might shrink. So you need to really, really understand well how this new metric is affecting your industry and your company. And then the last one, which is where we're spending probably most of our time, is to make sure founders and management teams and boards are focusing on cutting burn in order to extend runway. The easiest way to raise $3 million in this environment is to cut $250,000 a month from your burn. And we're making that message very clearly to our companies. And in fact, we're seeing that most of the companies that we're talking to have already begun this process. Many of them are reducing salaries across the board. Some are cutting their teams by 15, 20, 30%, depending on the industry that you're in. But this is something that the earlier and the more decisive you are in this, the better it will be. And that's the message that we're carrying to our companies.
Thank you, Ron. We're now going to talk a little bit about how our portfolio companies are actually leading the fight regarding both the virus and the situation that we're in. We are giving advice to our companies that they need to stay relevant. In an environment where it's virus 24/7, that's all they want to talk about on TV, it's all you're talking about online. It's very hard to try to get attention for autonomous driving or for sports tech. People are not necessarily receptive to that message. However, what's happening is that many of the long-term trends that we saw before the crisis, such as distance learning or work from home, e-commerce, they're now reaching an inflection point, what I would call a point of no return. Those trends have been accelerated beyond belief in the last couple of weeks, and I don't think that we're going to see a snapback to a status quo ante once this crisis is over. the market share that bricks and mortar have lost further to the online e-commerce is simply going to not go back to what it was before the crisis. And this really, I think, means that many of our companies need to reorient and to ride this wave. Remember that technologies for fighting pandemics are not trendy hype. Pandemics are here to stay. This one is perhaps, convinced us all of how great the danger is, but we've had them now for several years, the last couple of decades, and there's going to be another one after this. This one might not end in a single wave, and therefore we've got to be ready and realize that fighting these pandemics is an ongoing responsibility where investors have to take responsibility, because this whole area of technology has not garnered enough investor interest. People were not interested in vaccines. They weren't interested in epidemiological software or prediction of outbreak software. And we're finding now how many tools are missing. The head of the WHO called this a market failure, where we failed as a market to have the toolbox ready to fight. And we are here at OurCrowd resolving that we're going to go work with our investor base and our companies, as well as outside entrepreneurs, to find these opportunities and bring them to our community. Many of our companies are already serving the remote access, automation, social distancing markets, and you'd be surprised how many of our companies are already crisis relevant. And while the environment for funding has indeed become more challenging, investments, as Ron pointed out, are indeed getting done, and especially for those companies who are relevant to the crisis and who have proven business models and track records. The winners are going to get stronger and get money in this crisis. So let's talk about some of these companies that are engaged right now. First and foremost is a company called TytoCare, who make a rather remarkable set of diagnostic tools which enable essentially patients who are in quarantine to actually transmit in real time spectacular data to customers. This is being used in Israel's leading medical center, the Sheba Hospital, one of the 10 top hospitals in the world, where corona patients can literally diagnose themselves, not only giving good views of what's going on in the ear, but in the throat, in the lungs. And this is now getting interest around the world. TytoCare is a very strong and interesting company in the remote health monitoring area. Switch is a company doing disease management on mobile phones. They started off in the diabetes area, and they've now morphed into managing a whole variety of diseases, including different kinds of cancers and oncology. But now, of course, they're focusing on managing coronavirus, COVID-19, and getting a lot of interest in their application. Site Diagnostics, which we call the anti-Theranos, the company who's managed to get blood testing done with simply 2 little drops from a pinprick, they're finding a lot of interest in their ability to provide desktop analysis of blood in 10 minutes, such that they can do this in quarantine and allow hospitals to not commingle the COVID blood patient testing with the rest of the hospital. They're quite worried that COVID could break out into a hospital blood network from simply one mistake, and therefore having the ability to put an OLO machine, which is the site machine, under quarantine in the COVID wing is huge. And again, this is being used right now as we speak at Sheba. There's actually a press release going out today about this utilization. MeMed is another one of our companies on the front lines. They have a remarkable technology that can immediately distinguish between bacterial and viral infections. And there are a variety of applications that they're using now for COVID, in particular focusing on this very important early warning and early detection, where you can detect people who are not yet symptomatic, and especially looking at co-infections. Cryon is a company doing RPA, which is robotic process automation a critical technology in the banking, insurance, and other industries that can literally provide up to 95% reduction of hours required to do certain key processes. This is important in general. It's now become critical in the days when people are not working physically in the office. Now, most of the RPA applications required a lot of on-site consulting time. But what makes Cryon's RPA platform so powerful is they actually have AI-driven remote and automatic discovery and methodology and deployment such that you can do this even without consultants on site. And this becomes very, very interesting for the market. Sense Education, doing remote learning, in particular, allowing people to test in a complex way for unstructured data, whether it's an essay question or a piece of computer code. This is a real breakthrough. And given the fact that there are now 1 billion students who are on leave because they're not in schools worldwide, the whole distance learning business is blowing up, is simply now everybody understands how important it is, and Sense is in the middle of this. Chemtai is essentially an AI-driven exercise program that essentially gives you the benefit of having an AI-driven trainer in your home. Now, everybody realizes how important, especially during the crisis when we can't access our gyms, to keep fit. It keeps your immune system up. But to do this at home with Chemtai becomes a really important possibility in this environment. Pulm One is a company doing desktop pulmonary function or lung testing, a critical activity today when lungs are being compromised through the crisis. But in particular, it could be used as a pre-screen to determine who gets utilization of ventilators when there are not that many going around. Instead of just saying an age break off, if you're over 65, no ventilator, you're on your own. Now you can actually test for these patients and figure out who needs the help because of lung function impairment. Sanitize is a company using nitric oxide, which is a well-known antiviral as well as antibacterial. And this company has got a whole variety of applications, including nasal spray, sinus rinses, throat issues, an advanced kind of beyond alcogel, because this is not just alcohol. This is a compound that literally kicks the crap out of corona and other viruses, God willing. And Sanitize is now engaged in a whole series of discussions about ramping up their production and bringing this remarkable product to market. VocalZoom is doing contactless sensor arrays. They're working now with a major airport who want them to integrate not only their incredible laser-based vibration sensor, but temperature sensors and breath rate and whatnot, so that you can, without making contact from afar, manage the sensing of many, many passengers when we go back to having these passengers in airports, so that we can prevent the spread of the virus. We're going to be making new investments in the time of crisis. Do not assume that there are no investments until the crisis is over. It's true that many investors will focus on their core portfolio, such as us. We're focused intently on our portfolio, but the smart investors are going to be out there on the offense looking for opportunities, and that's also us. We know that some of the best deals are going to surface at these times. Prices have come down. It's now a buyer's market, which is about time, okay? Because valuations were, quite robust, let's say, before, and now they've come down, as Alec pointed out. And great companies that pass the stress test of the crisis and succeed will become very interesting. Cash is totally king. There's less competition out there. Many people have stopped or slowed down, but these good deals are going to become available at better prices. Companies with a corona thesis are going to rise to the top. And it's not only the medical companies, but those that are dealing with the social distancing area, and the terms are going to improve. Look for ratchets, things that protect the investor, as values continue to drop and warrant coverage for enhancing the upside. And finally, the governments around the world are responding to the crisis by providing capital. This is a new program that was just launched a couple of days ago here in Israel, where actually we were involved in discussions with the government. They've now essentially streamlined the ability for companies to get R&D money from the government who are fighting the crisis, and they will check them out within 48 hours and award significant grants within 10 days. We've never seen anything like this. We're very excited, but it's not just in Israel, it's also in the EU, where they've announced special programs, again, on an accelerated basis for early stage accelerator companies, as well as people who are developing even big programs where the government can put up to 45 million euros in these companies. And the deadlines are quick. They have to be submitted literally in the next couple of days. And we're working with many of our companies on this. We're getting a lot of press and trying to stay relevant ourselves, both in terms of online conferences and how we're keeping our business alive. Our companies are getting lots of press, and you'll see that continuing through the period. And Israel is getting a lot of press as a leader in the world, both in terms of technology, as well as having taken a lot of strong steps here at the governmental level early and leading the family of nations. Now there's some reflections I want to share with you on investors in this time. What should you be doing? First of all, be calm. Take a breath, take a chill pill, try to get some perspective. It's not easy, but let me tell you, this is not our first rodeo. Many of us have been here before. This is not our first crisis. I'm reminded back of my first crisis, which was 1987, when I was in the process of taking my first company public. And all of a sudden, the markets fell in a single day, 25% almost. I pick up the phone, I call my underwriter, and I said, hey, what does this mean for me and my company? And the underwriter said, you're screwed, don't talk to me again, and hung up. So I've seen a lot of this stuff, right? I've seen this both in 2000 and 2001, seen it in 2000, 2008. This is the way the world works. And we go up and we go down, but we come out. And things have changed dramatically in the last couple of weeks. It's hard to believe that only about 5 weeks ago, it'll be 5 weeks from tomorrow, we had our Global Investor Summit, where we had 23,000 people signed up and over 7,000 people in attendance in a very confined space, and not a single person contracted the virus. There was no transmission. It was safe. The world has changed big time. And we were very lucky that we got that done. But I, again, want to remind you that deals are still getting done. We're getting these term sheets and closings. And we are absolutely convinced that this is going to be a very interesting time to be making investments. But most importantly, we need to focus on working with our existing investments. Investors like us and you are going to need to triage the investments. Which ones are going to win, which ones are going to lose, and to focus on making the winners work and let the ones that are dying die, because they are going to not make it. This is part of our business that, unsuccessful companies happen all the time in this kind of investment. And there's going to be more of these unsuccessful companies in this stress of the crisis. Make sure, though, that you are saving money to back the winners. And sometimes the winners don't look that way right away, right? In other words, your portfolio is your friend. You have to make sure that you have not just 1 or 2 or 3 investments with us or in general. A smart investor has to have 10 or more portfolio investments. Otherwise, you have too much concentrated risk. And your portfolio should be diversified in a variety of ways, according to sector, because you can never tell what sector is going to be hot, right? Who would have known a month ago or 2 months ago that social distancing was going to be this important, or that fighting pandemics would be this important? But you have to have different sectors in your portfolio different geographies, different vintages, mean when you make the investment, and different stages of companies, both early stage and late stage. Try to keep your portfolio commitments relatively balanced, uniform numbers of dollars. The best way to get portfolio protection is to be invested in funds. And on OurCrowd, we offer right now 20 different funds in our stable. Each one gives you the opportunity to get in at a $50,000 investment. And there are new funds going to be coming, especially in this time of crisis. And we'll be talking to you shortly about them. OurCrowd's OC50 fund is a great way to get this kind of hyper diversification, great performance, and it allows you to have winners that will offset the problems of your losers. The art of follow-on investments becomes more important than ever before. When you make an investment, you have to reserve money, especially in the early stage, for a follow-on. And we recommend, especially in the early stage, that you reserve at least 100% of your initial investment. If you're going to be investing $50,000, you mentally take another $50,000 and you put it aside and say, this is for following on. When the company does well, it's an easy follow-on, because as the company goes up, you want to buy more of it. But sometimes you get a down round. Sometimes the company stumbles, or there's a bad economic climate like today, but the company is basically sound and needs to raise money at a lower valuation. You want to participate then as well. The way that you manage your portfolio through these follow-on opportunities is going to have a huge, huge impact on your performance. Many of these companies, the outsized amount of money made at exit comes from the last investors. It's no longer who was in first, it's who's in last. And you have to be ready for this. And we will try and support you as best we can through this process, providing you with information and analysis of these opportunities. So just to remind you, some pretty famous companies have had down rounds. Facebook in particular, back in 2008, if you look at their funding history, and this of course cuts off here at 50 billion back in 2011, it's now closer to 400 billion, bouncing all around. But basically, they went in the middle of that financial crisis from a $15 billion valuation where Li Ka-shing and the Samware brothers had invested to a $9 billion. So it went down from 15 to 9. That's a big drop. And yet it was a great investment. DST got in at 10, had another round down from the before, but those who invested in those down rounds were very, very happy later on. So vintage is really critical. Just like you average into the public markets, you don't try to time all of your investment at one time. You average in over years. You have to do the same thing with venture vintage. You never know which vintage is going to be the winner, but therefore you have to move your money in the venture investments over time. And what's also important to point out is that some of the best vintages were in down markets. When markets are down, valuations are down. So you're buying in cheaply, but your realizations happen not in a matter of months usually, but in a matter of several years when the valuations have recovered. And that's why down vintages are often very, very attractive. As you can see here, you can look back at the 2007 to 2009 crisis period. Those vintages were a lot better than the middle of the 2000s because people were buying low and then selling on later high. Obviously, the 2010 vintage was very good in the bull market. But the reality is that sometimes down markets produce really good vintage returns. And just a reminder that we're here to help. We're going to try to stay in touch with you on a regular basis with webinars and company updates. We're going to be giving you a schedule soon. Our investor relation managers are ready to assist you in any way that they can, and we look forward to your feedback. Please, please let us know what we can do to help you better in this time of crisis. And remember that smart investors have a smart approach for the tough times. Timing. Do not try to time the market. Make sure that you Invest even in the vintages where the down markets are happening. Those are really interesting. Classic buy low, sell high investing. Please take a flight to quality, investing in pure tech and companies that are winners. And most importantly, make sure that your time diversification is right and that you're deploying your money not in one fell swoop, but over time to get different vintages. So at this point, I'm going to turn it over to Lolly David, our business development partner at OurCrowd, to talk to you about how our business development activity is working in these times. Lolly?
Yes, hi. So the same messaging of we are here to help you and support you is the message that we share with our portfolio companies. We're literally acting as their extended business development teams. It's either them sending us a wish list of who they want to be in touch with and us working, trying to get them connected with those people and companies on the wish list. It's them sending us introductions to be added to the introduction request page on our website. Alec is going to show that in a minute. Or them basically using Connect, our business development platform, to connect them with different, again, companies and people. This is all leveraging the network, leveraging our relationships with you and with multinational corporations looking to do business with our portfolio companies. Interestingly, we're actually experiencing that people on the other end are very responsive, very prompt to response. People are working from home on their computers, and we're able to get a lot done. Obviously, we have a lot of business development opportunities that are Corona related, but also those that are not Corona related are getting progressed. So thank you very much. Back to you, John.
Thank you, Lolly. And now we're going to talk, both myself and Alec, about how to mobilize our community and then take your questions. So we intend to be in regular touch. We're moving even more of our systems online. Obviously, OurCrowd has been an online platform. That's who we are. An online website, mobile apps. However, we also have a lot of face-to-face activities. Over the years, we've done anywhere from 100 to 200 face-to-face events. We can't do them anymore, not for the foreseeable future. So we're going to have to be moving a lot more online. You'll see more webinars, more Zoom calls. We want you to be active with our companies. And if you have an ability to be a director or a member of an advisory board or an advisor or helper for our companies, please let us know. Ron Stern and Lolly want to hear from you so that we can deploy your talents on behalf of our companies. Please make sure you're opening the notices we send you about preemptive exercises and the follow-on rounds. It kills me how many people don't even open some of these messages. You're invested in a company. We need to report to you that they're raising more money. Open the message, look at it so that you can make a decision and not be caught unaware. And make sure that you're saving money for these kinds of important investments, because this later stage stuff is going to determine who's going to really make the money in these companies. Please refer us to new investments. If you're finding interesting new companies who are fighting pandemics or working on social distancing, we want to know and we want to lead investments there. Help us bring new investors to the table. We want to do this kind of a viral spread. It's important as we build our companies and raise money for them. More than ever, we need new investors who want to join us. Please introduce us to your friends and help us find opportunities and customers for our companies. Cannot tell you how many of our companies have seen multi-million-dollar contracts, sometimes actually double-digit million-dollar contracts as a result of OurCrowd introductions from our community. Please keep them coming, because today we need to find these opportunities more than ever. Help us spread portfolio news on your social networks. When there's news about companies like Tydo or Switch or Sanotize, please take those notices and put them up on your Facebook, LinkedIn, Instagram, share them to your email lists, blog about them. By helping us get that message, you help your investment and you help our community. And please also use our improved introductions feature on the website, which Alec is going to talk to you about right now.
Thank you, John. We recognize that these are very challenging times, and your first priority has got to be your health, the health of your family, the health of your employees to the extent you're running companies. And our priority for you is the health of your portfolio. And so when we ask of your time, we know that is a big ask. So I just want to make sure people understand our recognition of that. What John has alluded to, which is now up on your screen, is a way to stay engaged with us to the extent you can focus on what we're doing. There will be fewer opportunities, which is the top left, because we'll be just doing fewer deals. There will be deals, as John said, but there'll be fewer. But there's a way to engage to improve the health of your portfolio, which is the introductions feature that we introduced last August. Turn to the next page. If you click this, next slide, please. You come to back up one. You come to a page which shows a list of requests from our companies for introductions. It also highlights the companies that you're already invested in, which, not surprisingly, goes to the top of your screen because that should be a higher priority for you. We also will allow companies to remain anonymous. Hence, you see at the bottom, OurCrowd. When we're making a request, a company has asked the request to be anonymous. We have asked our companies to literally flood us with requests and to be as specific as possible so we can get them out to our global community. And that's where you come in. It's a very simple feature to you can go through each one, click no, it'll disappear. But on the rare occasion where you can actually be of assistance, where you've got that connection with a certain company or a physician, then you'll click yes, and then this screen comes up. You fill it out, click send, and you will hear from somebody on Lolly's team, and then we'll take it from there. So again, we recognize that it is these are challenging times, but we urge you to check this regularly because we will be getting more and more requests from our companies. Thank you.
Thank you, Alec. And now for some final comments. We believe that many of our startups will weather the storm, not just here in Israel, but abroad. About a third of our companies are abroad, 2/3 are here. But I think that Israel in particular is really well positioned to weather this storm. First of all, this is not our first crisis. Israel has a lot of experience, unfortunately, with crises, and that makes us resilient. We don't get freaked out too easily, okay? Although things are difficult now, we've had other difficulties before. Our companies in general are capital efficient. They're not big spenders, and they will, I think, do better than most in terms of a budget tightening environment. Deep technology is going to become more important now, especially as we fight pandemics and we develop remote applications using AI. This is going to play into Israel's strong suit, especially when it involves interdisciplinary technology, where you're combining chips and software, AI and medical technology all in one company. Israel does the interdisciplinary tech better than most. Israelis are really good at improvisation and piloting, less good about planning, but really good at moving on a dime quickly. And that kind of skill set is very useful in a crisis. Leading ecosystems around the world, such as Silicon Valley and Israel, are going to do better than the ones that are struggling. The government here is very supportive and proactive, as we've already discussed, and corporate venture is now more active in Israel than ever before, with 400 multinationals operating, in which Lolly and her team are in touch with. So a summary is that we're working here at OurCrowd like never before to meet the challenges. We're closely monitoring and analyzing both the world's health situation, economics, and markets, in order for us to be better leaders and stewards of your investment. We take the stewardship of your money very seriously, and we're working like crazy to make sure that we do the right job for you and ourselves. We're supporting our companies and seeking relevant new opportunities in a selective manner. We're working closely with our portfolio to reduce their burn and to weather the crisis better. Even despite the restrictions on our office, we're getting things done. We're functioning well. We actually just got out our K1s on time. Thank you, Robbie and team. Where possible, our companies are playing offense, both in fighting the virus and addressing the new economic realities. And we're going to update you regularly and move even more of our business online via webinars like this. Just to remind you, we're in this fight together. We really are thinking about you wherever you are in the world. We all are engaged in this, and we need your help, want your input, and we'll try to give you guidance as we go forward.